Marcus, something's really catching my eye in the markets right now. I mean, it's just wild. Capital seems to be betting against both sides of the Fed fight. How's that even possible?
Ah, Mara, you've hit on it, haven't you? It's not a contradiction when you look at what's truly driving the order book. Just last week, Warsh was confirmed, right? Most partisan Fed vote ever in modern history. And then you see these prices. December inflation above 3%, trading at 58 cents, 23 points above the disinflation story. But then the June rate cut, it's trading at 18 cents, 27 points below all this political demand for cuts. Same order book, same week. Most folks, they read that and they just assume one's mispriced. But they're not, Amara, they're not. It's the same trade.
Okay, so wait, if it's not a contradiction, what exactly is that trade? Because my gut, it screams, these can't both be true, but you're saying they are?
Exactly. It's capital pricing a regime where the inflation path runs hot, doesn't matter who's in the chair, and the rate path runs tight, regardless of who's demanding cuts. This isn't a soft landing trade. It's not a hard landing trade. This is a no landing trade, but with constraints, Amara, on both directions. When that December contract goes up and the June contract goes down in the same week, same book, same political backdrop, that's not a contradiction. That's the market telling you the optimization function changed. And the rhetoric? Well, it just hasn't caught up.
And no landing trade. That's a powerful way to put it. And you're saying the constraint isn't like sentiment or anything squishy. It's actual supply geometry? Can you unpack that for me?
Absolutely, Amara. It's not sentiment at all. Look at Brent crude this week, closed at $109.26 on May 15th. That's up 67% year over year, just massive. And why? The Strait of Hormuz remained effectively closed through that period. The International Energy Agency, the IEA, they warned the oil market could remain severely undersupplied until October, even if, fighting ended next month. That's not some monetary phenomenon the Fed can just route around. The chair can't just speak Brent back to $85. UBS, they have a forward curve that fades crude to 90 by year end, which sounds good. But the spot level, that's what the December contract is repricing against, not the forward. That spot price is the reality.
Oh, wow. So it's not what the Fed wants to happen in the future. It's what's happening right now that the market's reacting to. And that impacts, real people, doesn't it?
Precisely. The modal household, Amara, they don't experience the forward curve. They experience the spot price at the pump, the resets on their mortgage, the line item in the grocery scan. That's the bridge the order book is making. And the cable narrative, well, it isn't. It's a fundamental supply problem creating an inflation floor that monetary policy just can't reach.
So, the order book, it's not just seeing this one thing. It's like pricing in a whole sequence of events, right? What's the playbook capital is working from here?
Excellent question, Amara. Here's the order of operations, Amara. The order book is pricing in. First, geopolitical supply shock locks Brent above 100. Already happened, we've seen it. Second, price level transmission shows up in May CPI, which lands in mid-June. The May core CPI contract sits at 72 cents. That's the order book pricing a hot print. A really hot print. Third, the regional Fed presidents who put their dissent against the easing bias language into the April 29th statement, they are positioned to hold the line at the June 17th meeting. Beth Hammack, Neil Kashkari, Lori Logan, all three very clearly on record.
Okay, so the dissenters are locked in. And then Warsh, the new chair, he walks into all of that pressure, right?
Exactly. Fourth, Warsh presides over his first FOMC against that backdrop. Political pressure to cut, absolutely enormous. Structural environment that just won't permit it. Capital sees the sequence, Amara, and it prices both gaps. 18 cents on that June cut, that's what you pay when you believe the dissent record holds against the chair's political mandate. 58 cents on December inflation, that's what you pay when you believe the supply geometry runs through the resolution date. These are not contradictions, Amara. They're the same bet on the same regime.
It's so clear when you put it that way. But you mentioned something about a third element earlier, something nobody's pricing because it doesn't trade. What's that about?
Ah, yes, the silence. Powell will vote in June, Amara. He committed to keep a low profile. This is the first time in 80 years a former chair has stayed on the board with a vote and no voice. The Senate, they confirmed his successor, Warsh, on a 54-45 split. Only Senator Fetterman crossed from the Democratic caucus, which is telling, really. And the DOJ investigation that Senator Tillis used to block the Warsh confirmation, it was only dropped when a U.S. attorney agreed to drop it. This isn't just a partisan story, you know? That's an operational fact. The boundaries between branches were treated as tunable parameters by every named actor in the sequence.
So, when the dissenters and Warsh collide on June 17th, and the data is hot, whose vote does Powell cast, and whose voice carries it? Because you're right, there's no contract for that.
Precisely. The order book can't price that. The silence, Amara, that's the variable that decides which way the gap closes. It's the piece that should make any analyst nervous, and you can see it in how the contracts are positioned. The June rate cut at 18 cents implies the dissent holds. The December inflation contract at 58 implies the price level runs through. Neither contracts prices what happens if Powell breaks his silence and aligns with the dissenters at the meeting. If he votes with Hammack, Kashkari, and Logan against easing bias language, that's a former chair publicly constraining the incoming chair's first policy gesture. That's not a market event. That's an institutional event the contracts just can't price.
Wow, that really makes you think about the layers here. And this whole shift in the optimization function, how does that translate to like the everyday household? Because that's ultimately where it hits, right?
Absolutely. Powell, back on January 28th in his press conference, he actually named the mechanism that makes this real at the household level. He was asked about the gap between the official, somewhat elevated inflation framing and the household-level finding that the cost of living remained the #1 issue. And he pointed to the wealth asset distribution. Higher-income households own real estate and securities. Asset values rose. That wealth effect translation into consumption explained the divergence between aggregate spending strength and the modal household experience.
So the richer households are doing okay because their assets are up, but everyone else, not so much.
Exactly. And here's the kicker. That gap doesn't close from the top down. It widens. The modal household responds with balance sheet defense. Shorter duration savings, deferred large discretionary purchases, credit card balances carried into the next reset cycle. The New York Fed's quarterly report on household debt and credit, it registers that pattern in the delinquency series. The recursion is structural, Amara. Aggregate household behavior feeds the model. The model conditions the policy. The policy reshapes the environment that produces the next round of household behavior. The optimization function itself is now under revision by the institution being trained on the data. That, Amara, that's the trade beneath the trade. The order book is pricing the optimization function shift before the rhetorical layer even admits it.
The trade beneath the trade. I love that. So, what are the critical signals we need to be watching to see how this gap closes? When does it become, undeniable?
Well, look at the migration paths. If Brent holds above 100 through Friday, and right now there's no Hormuz reopening on the calendar, that December inflation contract, it tests 65 cents. The breaker? A downside surprise on May CPI, a Hormuz resolution, or a Warsh statement ratifying the prior framework. None of those are on the calendar right now. None have signals yet. And if the print comes in above 0.3% month over month, which is what that 72-cent contract implies, the June cut contract compresses toward 10 cents. The order book moves from improbable to effectively impossible on June easing. The cost of being wrong on the rate cut at 18 cents is bounded. But Amara, the cost of being wrong on December inflation at 58? That's not. Long inflation at 58 pays 1.7 to 1 on resolution. Short inflation at 58 pays 72 cents and requires the gap to close from the upside. That asymmetry tells you which way capital is leaning.
So the market's really bracing for a hot inflation print and no cuts, essentially.
It is.
And the harder return isn't the gap closing on the inflation side. It's what happens if the institutional independence question stops being rhetorical and becomes operational. If June 17th produces a hot print, an active dissent, a chair under political pressure, and Powell breaking his silence to vote with the dissenters, the order book has been hedging that scenario for weeks. The next prices won't be hedges, Amara. They'll be repositioning. By the time that gap closes, consumption deferral has compounded into a retail sales contraction the seasonally adjusted print can't hide. The corporate refinancing pipeline? Frozen. And political pressure has migrated from demand for cuts to demand for someone to blame. That's the path the order book is pricing against, and it's the path nobody in the rhetorical layer has named yet.
The gap doesn't close on the upside, it closes on the downside, and it's already closing. So what are the 3 big things to watch right now?
3 dated events, Amara. April PCE releases May 29th, that's 12 days from today. First observable test. The December inflation contract registers the read within hours. Then the BLS May CPI release lands in mid-June, days before the June 17th FOMC. Whatever prints, it lands on a chair confirmed under the most partisan vote in Fed history, who hasn't yet made a public framework statement, with 3 regional bank presidents on record against easing bias language and a former chair holding his silence with a vote. And finally, the June 10th close on the May core CPI contract is the lock. If it remains above 55 cents at the close of trading that day, the institutional pressure path on the June FOMC is the priced base case. If it falls below 55, the disinflation frame has recovered. 1 print, 1 threshold, 1 date. Watch print crude this week. Watch the May core CPI contract close on June 10th. Watch what Worse says first. The order book has named the trade. The institutional layer hasn't yet named what it's doing. Whichever side closes the gap first tomorrow, that's the side that already lost it.
Thank you for watching. Please make sure to like, comment, share, and subscribe to help grow our network. Marcus, that's an intense breakdown of what's unfolding. For our viewers trying to navigate this complex landscape, what does this system stress test truly mean for them?
It means the rhetorical layer is struggling to keep pace with the market's reality. Capital has already priced the outcome, while the institutional players are still trying to define the problem. Those 3 signals I mentioned, April PCE, May CPI, and Warsh's initial moves, they aren't just economic data points, Amara. They are institutional stress tests, revealing where the true power lies.
A stress test for the very architecture of policy, it seems. You're painting a picture where the system itself is being forced to adapt, rather than guiding the outcome. It's almost unsettlingly inevitable, the way you connect these dots.
Precisely. The trade beneath the trade isn't just about inflation or interest rates. It's about who yields first, the unyielding supply geometry, the political will, or the integrity of the institution. And Powell's silence? That, Amara, is the ghost in the machine, an unpriced variable that could shatter the expected path of least resistance.
The silence. A vote that could echo louder than any speech. Our network will certainly be watching those dates and those critical signals you've given us. A truly fascinating and, frankly, nerve-wracking unraveling of the market's deepest truths. Thank you, Marcus, for connecting these unseen threads for us.